Okay, good afternoon. So I hope that Yap and Yanisha is doing well. Okay, so can you see the screen? Can you see the screen? Can you see this screen? Yes, I can. All right. Okay, we will start with the chapter one. Okay. Just to make it clear, yeah, that this investment and financial analysis and the financial management that you will learn. Okay, I can say that the module is almost it's not almost 90% difference. Yeah, there are only one chapter. I think there is a one chapter that is redundant. That means you will learn the same chapter in this module and also financial management module as well. Okay, so just to let you know about that. All right. So, as far as investment and financial analysis is concerned, there are eight chapters. Yeah, and then each chapter will have a different techniques, different calculation on how to analyze financial components. Yeah, for a company. All right. So the chapter one is about interpreting financial statement. Okay. So usually, when we are doing interpreting financial statement, usually we will look and analyze the components, yeah, based on the ratio calculation and so on. That one you will learn in the financial management in the later chapter. But for this chapter one, yeah, we are more focusing on analyzing financial statement by using cash flow analysis method. Okay, so let's have a look at the overview here, shall we? All right. Why interpretation of financial statement or why analysis of statement is so important, yeah, especially for financial analysts, especially for business analysts, and also investors out there. Okay, so the first one is to assess the performance. Yeah, of course, we want to see whether the company is financially good or the company is having bad financial. Yeah, so that is the first one. Okay, the performance indicated that either the company is good financially or bad financially. Yeah. Okay, the second one is to planning for future action. Okay, let's say if company financially have some weaknesses. Okay, what will be the action and what will be the mitigation in order to ensure, yeah, that the business growth will be there. All right. We don't want the trouble company to become more trouble and then will lead to bankruptcy and solvency. Yeah. All right. This interpretation of financial statement skill is probably used by investors, creditors, and prospect. Okay, investors need this one financial statement because they don't want their money to lose. Yeah, they want to invest any company which can bring the profit. Yeah, it's simple as that. Okay, as far as creditors is concerned, yeah, especially for supplier, okay. So those supplier, yeah, who sometimes company contacted them in order to get raw materials, yeah, definitely supplier will look at either the company have a good track record or not. Yeah, if the company has a good track record, yes, supplier will trust them and they will have a quite a very good business partners. Yeah. And then prospect. We're talking about either companies want to be merged or company wants to become a joint partner or a company that to become an investor itself. Yeah. So if they're seeing the financial performance, they will see whether does company have a prospect or not. Yeah. So that is why, yeah, interpretation of financial statement is so important. And in corporate world, profitability will not guarantee success of the company. All right, profit is good, but it's not guaranteed to be success. There is no use of company being profit, but at the same time, they still have a lot of liabilities. Yeah, a lot of debts. They are not able to commit to the liability. All right. So profitability is not everything. Therefore, another item that can support will be cash flow. Okay, because why? Yeah. As an old saying, that cash is king. Okay, let's have a look at the cash flow cycle. Okay, as far as cash flow cycle is concerned, the cash is flow everywhere. Yeah. Okay, inside the company and outside the company. So why cash flow cycle is essential here is shows close interplay between operation and finances. Okay. So I will illustrate to you how it works. Okay, two cash movement are cash inflow and cash outflow via. Okay, so these are the explanation there. But let me explain to you one by one. Okay, let's say this is a company's cash. Okay, company has money. Okay, so okay, first thing first, we have a look at the fixed asset. Okay, if you learn accounting, you know that fixed asset is a asset that have a maturity which is more than 1 year. Okay, and usually they will use for operation, such as machine, plant, land, building, and so on. Okay, so okay, let's have a look at cash perspective here. The money of cash goes to fixed asset. Okay, that means the cash will be outflow. Okay, why outflow? Because this one. Okay, company will use cash to purchase fixed asset for investment. For example, investing in land, investment in building. So they are purchasing those assets. Okay, why they are purchasing those asset? Because this fixed asset will used by the company to operate. Okay, can you imagine if the company does not have building? Can you imagine if the company does not have machine? They cannot run the business as smooth as they can. So fixed asset is very essential for company to ensure production and also for operation. Okay, so that is the first part. All right, the incomplete part here. Why fixed asset convert into cash? Okay, I repeat again. Why fixed asset convert into cash? That means this one company, that means cash coming inside the company. That means the money will be in inflow. It is because company were selling asset. Okay, for example, company sell their building, company sell their machines. So if they're selling the machines, the money will be inflow to the cash account. Okay, so the differences is okay, cash goes to fixed asset means that company will make investment, that means purchase fixed asset, and fixed money will turn into cash if the company is selling asset. So that is the first part. Then we done with this one. Okay, how about inventory? Okay, how about inventory? All right, cash inflow. That means I will go for the outflow first. Cash goes to inventory. That means company will purchase inventory such as raw materials. They are purchasing what we call incomplete materials, and then spare parts and so on. Okay, for example, if the company is running cement, cement machines, cements, for building a house, so therefore they will purchase sand, and that is the first one. Or maybe if the company is run sorry if the business is PC, that means the component will be spare part, the inventory will be spare part. So therefore cash will go to inventory because they purchasing inventory and also cost production. Okay. However, the inventory will convert into cash if the sales happen. Okay. For example, one of the inventory is finished good. Finished good. That means the product is already produced and then sell to the customer. Customer will buy and the money will goes into the cash account. So that means cash sales. It can be credit sale as well, but cash convert into cash, it will take some time. So that is the second part of inventory. Okay, the third part, account receivable, which is debtors. This is the customer that not pay yet. Okay, this is credit sale. Yes, this is correct. That means inventory. That means product that sell to the debtors. Or customer who has not pay yet. Okay, and then once the debtors has money, and then they will pay back to the company, and then they here it goes. Cash inflow. Yeah, and another one, the direct method, which is cash sale. Okay, cash sale means that those customer pay the product, and then they will pay and straight goes away to company's account. Okay, what happens if cash account goes to inventory and also goes to the account receivable and go back to the inventory? Okay, it is because this one, refunds or sales return. Yeah, that means yeah, those customer before they buying the product, but they found out that the product is defect or malfunction, so that's why they need refund. So once they need refund, and then the inventory will be returned to the company, and then yeah, the cash will be returned to the customer. So that is how it goes. All right, one more thing that I left out, this one. Fixed asset goes to inventory. Okay, what is that happen? Because remember, yeah, if because you learn accounting, therefore some of the fixed asset cannot be last longer. Yeah, they will have some time whereby the value will be less. Yeah, depreciate. Yeah, regardless of using a straight line or reducing balance. Yeah, that one will be in the later chapter if you have. Yeah. Okay. Balance sheet. The first component in financial statement is balance sheet, which is statement of financial position. It is a financial snapshot whereby all the asset the company owns versus all claims against those asset. Okay. In other words, it shows how company finance their asset by liabilities or by equities. Okay. Let me interpret to you about this one. This is an asset side. This is a liability and equity. We already knew that asset is equal to liability and equity. All right. So we as an analyst sometimes might questioning this company. Okay, we have 355 asset. Okay, that means we own cash, we own account receivable, we own inventory, and we own fixed asset. But the question here is, where do they get this money from? Yeah, to buy this 355 dollar asset. Okay, either from liability or either from equity. All right. So if you ask me, is it liability or equity is better? Okay, so for me, yeah, the equity is better because you don't have any commitment or financial obligation. Yeah, that you are, because you are selling shares, yeah, by equity. So therefore, there is no element of debt. Liabilities, yes, yeah, you have some elements of debt. Yeah, no matter the company is good or bad, yeah, leading to bankruptcy, you still need to pay loans. Yeah, that is a problem with the liability. So therefore, this one already explained here. Asset which is equal to liabilities and equities. But come again, as you can see here, okay, 235 equities, and this one 120 liabilities. That means 100 plus 20. Yeah. 120 versus 235. That means the more money comes from equity. So therefore we can say here that the company is healthy because most of the asset purchase come from equity, which is $235 compared to $120. Can you imagine, yeah, if liability is more than equity? So let's say liability is 300 and equity is only 55, which is company have more debts than equity capital. So which is not good. Yeah. So that is how you want to interpret simply, yeah, for financial position. Are the companies in the good position or are the companies in the bad position? Based on this one, we can say it's a good position because most of the money come from equity. Yeah, compared to liabilities, 120. Okay, income statement, it records income versus expenses. Yeah, because this is the income. Yeah. Okay, the only income that they have. All right. So therefore, yep, these are the expenses. Wages, company have to pay wages. They have to purchase materials, and then some depreciation there. So 900 plus this one plus this. Sorry, minus this one, minus this one, minus this one. We come gross profit 345. Minus 210 other expenses minus interest will come 125. Minus 40 it will come 85. Okay, so can you imagine, yeah, from the sales of 900, yeah, okay, and then you less expenses, yeah, that means only 85 ringgit left, $85 left, yeah. So the format here is minus everything, yeah. Okay, and then this cash flow statement, okay, I will explain the theory part first. Yeah, later on we will go for calculation. Yeah. Okay, it reports via the movement of cash, which are cash inflow and outflow. So as you can see here, there are two possibilities. Okay, we want to see the company. Are they more on inflow side or are they more on outflow side? Inflow means cash coming into the company. Outflow means that cash out from the company. So if you are in the company's perspective, yeah, cash inflow is better than cash outflow. We don't want cash outflow to have so many outside the company. Okay, so therefore cash inflow is necessary. It also plays as a bridge whereby it links between the movement of yearly balance sheet and yearly income statement. Where I'm saying yearly, it means that if you want to analyze cash flow, you need to look at the current year and the last year. I repeat again, when we're talking about the bridge and the links between yearly balance sheet and income statement, it says that you want to analyze balance sheet, you need to compare this year and last year. In the calculation, you will know that later on. Yeah, where I show you that. In the later session, we will discuss on how to construct cash flow statement. Yeah. Okay, so here, yeah, as you can see, yeah, there is a gap. This is the gap. Okay, why this gap exists? Because this is the beginning. That means last year. Okay, at the end means that means next current year. Yeah. For example, this one 2018. And this one is 2017. The bridge or the gap here is what we call as the cash flow. Okay, whether is it inflow or is it outflow. So, asset at the beginning, we're talking about cash flow related to asset. They have three, which is operating, investing, and financing. We will see it later. I think we have it, right? Okay, later on we have. And then liabilities at the beginning only at the balance sheet because liabilities is inside balance sheet. And then yeah, equity at the beginning, which is shareholders equity related to revenue and expenses, which is the difference between those two, yeah, is net income. Yeah. Okay, so that is some what we call as a picture about it. The main reason why cash flow is mainly focused on asset because of solvency matters. That is having enough cash in the bank to pay bills and they become due. That means cash is everything. Yeah, without cash, company cannot pay the small expenses. I mean, everyday expenses or current expenses, or what we call, for example, like to pay electricity, to pay wages, to pay salaries, yeah, to pay anything that inside the company. Yeah, and sometimes also cash flow can be pay outside of the company as well. So therefore, there are three categories of cash flow. The first one is operating cash flow, cash provided or consumed by company. That means we're talking about operating. Operating is more on the operation inside company. Yeah, electricity bill. Yeah, stationery. Yeah, and then fixed asset. Yeah, salaries and so on. Yeah. All right, the second one, investing cash flow, yeah, from selling and buying fixed asset. Yeah, we're talking about fixed asset only, yeah, which is machine, yeah, and then vehicles, land, buildings, and so on. Um, I want to go back to operating cash flow that I give an example of machinery. There is not. Machinery is more on investing cash flow. Yeah. And the last one, financing cash flow. That means money in and money out from funding activities. That means getting money and payback money, which is mainly from liabilities and also equities. Yeah. Okay. Before we proceed, just to cross check. Okay. Can repeat again? So which part, Yanisha, you want me to repeat? No. Okay. Later on, we have a recording part later on. I will share to you later. Okay. Yep. Any question? Okay. Tak wrong. No. Okay. We take a 3 minutes break, and then after that, we will proceed on the calculation part. 3 minutes. Okay, so let's continue with the next part. Okay, here is a guideline set on how to construct cash flow statement. So the guideline is based on the diagram that I give you earlier. This one. Okay, so we want to detect whether the differences is positive or negative, and then at the same time, what will be the effect of the cash flow. Okay. So you need to understand the guidelines before you come out with the calculation. All right. So the first guideline here is to calculate the net changes, whereby the amount for the current year minus current for the the last year for each financial item. For example, current asset for the current year minus current asset from last year. Okay, and then liabilities for current year minus liabilities last year. There is just example. I will give you later on the details on it. And then identify the effect on the changes. Once you find the net changes, either positive changes or negative changes, you will need to identify the effect on the changes. Okay, so the first one is asset one. Let's have a look at the asset. Okay, let's say if net change is increase. Increase means that, okay, let's say I give you 2 years. Let's say 2019 and 2020. Okay, let's say asset is increased by 10,000. Okay, let's say in asset increased by 10,000. That means from 2019 until 2020, asset is increased by 10K. All right. What will happen on the cash flow because which is decrease. Okay, I tell you why. If you see here, there's is increase. Yeah, asset increased by 10K, but somehow the cash flow decreased by 10K. Why? It is because cash outflow more due to purchase more asset. That means, if you purchase furniture for 10K, that means your asset will be increased by 10K. But somehow your cash flow is decreased because, the money is outflow to pay furnitures. Okay, yeah, you got what I mean, right? I hope you got what I mean. Okay, the asset is increased, but the cash is decreased because you purchase more asset. Purchase more asset is more on this one. Cash outflow is more on this one. Yeah, that is the first part. Okay, asset is some kind like quite reverse part. All right. What if let's say net change is decreased? That means the value of asset is decreased by 10,000. That means let's say 2019 to 2020, which is let's say 60K into 2019, and 2020 your asset will become 50K. That means the difference is negative 10,000. That means decrease. Therefore, the impact of cash flow will be reversed around, which is increase. Why? Because cash inflow due to more sell of more asset. The company is decided to sell furnitures, to sell vehicles, to sell land and building. Therefore, there will be a buyer that buy those assets, and then the money will be injected to the company. So sell off more asset, which is decrease, cash inflow, which is increase. So that is the first part. Okay. Second here is a guideline is liabilities and equities. Okay, liabilities relationship with net changes and cash inflow is the same. Yeah. Okay, you see here, liabilities increase. Yeah, liabilities increase because the cash flow also increase. Why? Cash inflow more due to additional loan and additional equity fund from shareholders. Okay, I give you an example. If you let's say if you have a loan, 10,000. Yeah, 10,000, and then next year you apply another loan also 20,000. So therefore your cash will be 30,000. 10,000 plus 20,000 become 30,000. So that's why the increase. Equity also same thing. Yeah, currently you have 1,000 shares. Yeah, that means investor buying shares from you. That means you have 1,000. And then next year 2,000. Yeah, 2,000 ringgit money coming from selling shares. That means 1,000 plus 2,000 is equal to 3,000. So that's why cash flow increase because equity also increase as well. And decrease, this one net change, liabilities and equity decrease. Why? Because liability it decrease because you pay off loans. Yeah, you reduce debt. Yeah. And then at the same time for equity, you return back shareholders' money. The money that invested before, you return back the money to the shareholders after selling shares and dividend paid. And sometimes dividend paid also is a decrease as well. Because dividend paid means that the company will distribute profit to the investor or shareholder. Okay, so remember, asset is a reverse around, but for liabilities and equities is the same. And then after that, once you identify those changes and impact on cash flow, you need to classify into three sections. Remember that I mentioned to you earlier about this one. Operating cash flow, investing cash flow, and financing cash flow. Okay, operating cash flow means that cash flow is come from operation. That means operation in the company. So asset that you need to put into cash flow operation, which is all current asset item except cash and bank balances. Cash and bank balances you cannot put yet because cash and bank balances you will put as a final answer. Yeah, that is the first one. Okay. The second one is liabilities, which is only current liabilities. Yeah, accounts payable, creditors, notes payable, and accruals, all current liabilities. For equities, only dividend paid because dividend paid you need to calculate. Yeah, later. Yeah, dividend paid. Later on, I will show you. Income statement, just put current year net income. Yeah, which is net profit for the current year only. Yeah, do not put last year. Last year does not count. Okay, for cash flow investment, which is CFI. Okay, at the assets, only asset side, fixed asset only. Fixed asset only you put as a cash flow investment. Yeah, and depreciation as well. And the last one, cash flow financing, which is usually from two sources, liabilities and equities. Liabilities, all long-term liabilities or non-current liabilities. And for equities, for all equities except retained earnings. Because retained earning, you will be used to pay dividend. Okay. Alright, so these are the format, but this one is just a general format only. If any sum of the item does not included, you just put as zero. Don't need to include. This one is just a general format only. Okay, here are some example. You see here, they give to you the current year and the last year, 2009 and 2008. So therefore, you need to find the differences between those 2 years, and then later on we will construct a cash flow statement. Okay, the net income given is for the current year. Okay, if they given net income for the last year, just ignore. Do not have to do anything about it. Okay, so these are the net changes. That means the difference between each item. For example, 2009, 40,000 minus 2008, 30,000, which is 10,000. There are some net changes positive, and then some of it are negative ones. Yeah. Okay. So this is the one. Yeah. Negative. Zero means that similar. Okay, and then after that, you need to identify the effect. Okay, but this one, why I put here dash because cash. Cash is usually the final answer. The final answer. Okay, and then I told you that if increase by increase in asset, that means decrease in cash flow. If decrease in asset, that means increase in cash flow. But this one similar, liabilities and equities, Positive means increase, negative means decrease. And then in the later part, retained earnings, this one. Okay, current year net income minus net retained earnings, that means last current year retained earning minus last year retained earning, 10,000. 60 minus 50 is 10,000. Net income 10,000. That means current year net income minus difference between 2 years cash flow. Retained earnings. The effect will be zero. Yeah. That means if you have some amount, that means this one is under dividend paid, which is uh, negative, dividend paid. Okay, and then you need to identify which part, CFO or CFI or CFF. CFO cash flow operation, CFI cash flow investment, CFF is cash flow financing. Yeah, dividend paid. Okay, and then construct this one. All right, so you can have a look at that later. Cash ending and cash beginning. Cash beginning, that means the last year, and ending, that means the current year. Yeah. Okay, and then these are some comments. Later on, you will see. Okay. Any question before we proceed with calculation as some sample? Yep, and Yanisha, any question? Okay, all right. All right, let's move on to the this one. Okay, I give you yeah, wait, let me see which one that I think is the quite difficult one. Okay, I think I should go with this one, question 4. Okay, let's have a look at question 4. Okay, the balance sheet of Taming Sari Holdings as at 31st December for 2 consecutive years was presented as follows. So they give you 2011 and 2012. Definitely 2012 is the current year. 2011 is the last year. Yeah. So these are the asset, and then these are the liabilities, and then these are the net income. So therefore, yeah, the net income that we will choose is only this one. 28545. This one, ignore. Okay, ignore. All right. Let us do some calculation on that one because I think it's quite difficult to put it. Okay, wait a minute. One sec. Give me some time to do. Okay. All right. Okay, so we need to find the differences between this year and last year. Okay, by using calculator, first thing first, we need to do a calculation. Okay, where's the calculator? All right, view scientific. Okay, let's have a look at the first one. Yeah, 25200 minus with 36000. This one. Yeah, 25200 minus 3600 negative 10 8000. So that means negative 10 8000. Okay, we need to look at the differences first. We should put as a symbol. All right, the second part for marketable securities, 2012 minus 2011, 39960 minus 3600. If I made a mistake in calculation, please let me know. 9360. Second part. Okay, the third part here is account receivable, difference between 2012 and 2011, 72960 minus 66000, you will get 6960. Okay, the third part. Okay, next part, one inventory is 17160 minus 48000, you will get negative 30840. Bracket means negative, And then the next one, 73440 minus 84000. That means 10560. Okay, and then prepayment 18000 minus 24000, negative 6000. Total asset don't have to, because it represent everything there. Yeah. Alright. Sampai there. Okay, I hope you're clear about this one. Okay, let's have a look at liability and equity. Okay, just a gap here, so I hope you can catch a little bit. 18,000 minus 36,000, which is negative 18,000. Okay, the second part, notes payable, 24,000 minus 21,600, 2,400. Accruals, yeah, 22,800 minus 18,000, 4,800. Other current liabilities, which is 12,000 minus 30,000, 24,000. Next, yeah, bonds, 91,140 minus 42,000, 22,860. And then the next part, preferred shares, 54,600 minus 54,600, no changes. Common shares, same, no changes. 36 minus 36 is 0. Retained earnings. Okay, you need to just calculate the differences, but we will do for the dividend paid. 30180 minus 49. Okay, and then of course the last part will be current net income. 28,545. Okay, so that is differences. This amount we will put later on in the cash flow statement. But of course, yeah, we need to classify whether it is CFO, CFI, or CFF. Okay, open your mic, microphone, Yap and Yanisha, because I'm out of screen right now. Okay, just asking. Okay, Yap, for cash, do we have to put anything CFO, CFI, or CFF? Yap, anything?
Sorry, sir. Can you repeat?
No, right? Because cash is what we call as a final answer, right? This is your
Yes.
final answer, eh? Okay. Next, Yanisha, this one, marketable security. Is it CFO, CFI, or CFF?
So I don't know, sir. No idea.
No idea. Okay, fine. Yep. Any answers? CFO, CFI, or CFF?
No idea, sir.
You don't know. Okay, never mind. Okay, off your mind. Let me give you the answer. Okay, for all current asset, this one, marketable securities, we put under CFO. Yeah. CFO. Account receivable, which is current asset, also under CFO. Okay, inventories also we put under CFO because it's a current asset. But for net fixed asset, okay, net fixed asset, you see here the word fixed asset, we cannot put as CFO. We put as a CFI, cash flow investment. Yeah, cash flow investment. Okay, and then the last part, prepayment. Prepayment is under current asset. We put under CFO also. Yeah, so that is the first part. All right, for account payable, this one is it under current liabilities, right? So if current liabilities, we put there under CFO. Yeah. Notes payable also under CFO because current liabilities. Accrual also under current liabilities, CFO. Other current liabilities, this one current liabilities also, yeah, CFO as well. But this one, bonds, okay, bonds, this is the long-term liabilities. If long-term liabilities, we put under CFF, yeah, cash flow financing. Okay, and then, okay, wait a minute, I cross-check with this one. Okay, that capital, no, return earnings, yeah, return earnings, CFO. Net income CFO, dividend. All right. Okay, for this one, I put here 2 stars because I have some special calculation. And this one, net income, you put under CFO, yeah, cash flow operation. Okay, the last part here is one, . Okay, dividend paid. 1 . 1 . 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1. 1 dividend paid. Right, so dividend paid, which is net income minus changes in retained earnings. So net income, that means current year net income, which is this one, 28545 minus with this one. Okay, so this one, 28545 minus with 100, 0. So you will get the answer of 18165. This one, okay, negative, Okay, why I'm saying negative? Because it's paid. Okay, paid means negative, It's paid negative, money out. Okay, so that is how to calculate this dividend paid, because dividend paid you will put at the cash flow, Okay, once we are done, okay, we need to do a statement, Okay, this company called as Sari Holdings. Okay, cash flow statement. That's that. Look back at the question. 2012. Okay, so 2012. Okay, give me some time to do the table. Okay, you might wondering why I come up with the two column of RM. Okay, this one is more on the detail calculation, and this one is more on sum, or summary or general calculation, Okay. Just to make it clean, there is no specific differences between those two. Okay, so first thing first is just to cross check. Cash flow operation, which is CFO. Okay, we need to put anything that related to cash flow operation. All right. So the first thing first is current year net income, net profit, net income. It's the same, Okay, current year net profit, as you can see, net income here, this one, 28545. Yeah, current income here. Do not 11,000 is not there. 28545. Okay, and then add, Okay, what do you want to add? Add whatever that increase effect in CFO. Okay. So that means in this one, as you can see here, even though the difference is positive, which is from 30,600 ringgit to 39, it means that the asset is increased. However, the effect will be decreased. Yeah. So effect will be, I put a symbol there. What is the button? decrease. Okay, effect decrease. Okay, this one also I forgot. Effect also decrease as well. Okay. This one inventories. Okay, inventories. Yeah, because a negative that means they are sell off the inventories, which is inventories is reduced. Therefore, the effect will be decreased. Yeah, increase. Okay, for CFI because of the selling asset, so therefore effect will be decreased. Yeah, and prepayment because they reduce prepayment. Okay, but for this one, account payable, effect also decrease because they pay off some of the loans. Yeah. Notes payable also same thing. Okay. Effect increase because they add more loans. They add more loans. Accruals also effect increase as well. So this one in liabilities. Bonds. Isn't it 49,140 minus 42,000? 91,940 minus 22,860. Yeah, negative. And the effect is decrease. Okay, no changes. Dividend paid, that means negative, which is decrease. And net income is still maintained. Okay, done already. Okay, so go for the statement. Okay, you need to add whatever the effect is increase. Yeah. Okay, so the first one is effect increase. This one, effect increase. Hold on. Okay, so the first one is inventories. Okay, increase in inventories is 3840. Okay, and then okay, the first one is done. Okay, the second one is this one, effect increase. Sorry, this is CFI. CFI, you cannot do that. CFO first, Okay, this one, prepayment. Okay, increase in prepayment amount to 6,000. Okay, anything else need to add? CFO increase, this one. Okay, this one notes payable. Okay, notes payable is 2,400. Okay, next. Okay, next is this one, effect increase also CFO. Okay, which is accruals. Okay, accruals amount is 4,800. Okay, what else we need to add? CFO, yes, this one. Other current liabilities, 24,000. Okay. Right, and then here there is nothing more. This one net income. Net income done. Net income done already. Sorry, net income done. Okay, we need two less. Yeah, add is done everything. As add is okay. Now we go for the decrease one. Yeah, effect decrease CFO. The first one is marketable securities. Marketable securities 9360. Okay, just to bear in mind that this chapter will answer in section C. That means long answer, long calculation. Okay, the next part, account receivable. Okay, I forget. Less means that minus, so we need to minus. Negative, Account receivable is 9690. 6960. Okay, and then after that, is there any other CFO left? Or this one? Account payable. Account payables 18,000. 18,000. Okay, like that, this one, do not forget dividend paid. This one CFO also, because the word paid. Dividend paid must be minus, yeah. Okay, how much you minus? 18165. Okay, once you are done, that means you need to find total, yeah, CFO, yeah. Okay, by using calculator, let's calculate, yeah. 28545 plus 30840 plus 6,000 plus 2400 plus 4800 plus 24000 plus, sorry, not plus, minus 9360 minus 6960 minus 18,000 minus 18165 44100. So that is the first part. Okay, so that is the first part. Okay, any questions so far on the first part, CFO, before we proceed with the second part? Okay. Any question? Yep, and Yanisha? Okay. Okay, the second part is cash flow investment, which is CFI. Okay, so anything that relates to CFI, yeah, you need to put inside. Okay, cash flow investment, go back up there. Okay, this one, the first one, next fixed asset, the CFI. I put here as a red. I think it's a green highlight. Okay, so this one, yeah, effect increase, Effect increase, that means because they are selling fixed asset, So you need to add because of increase, yeah, add decrease in, okay, decrease in, okay, decrease in fixed asset. So this one is 10,560. Okay. All right. The second one, yeah, the second one is let's see if we have any CFI. No, only one CFI. So therefore, yeah, total CFI which is equal to 10,560. It's only one, yeah, and nothing else. And now we are move on to cash flow financing, CFF. Okay, for CFF, what we have here in CFF, only one item only, which is bonds, okay, which is bond. Let's say I put here as gray. Effect will be decrease, decrease which is less. Decrease in bonds. So therefore, the decrease in bonds will be 22860. Okay, so the answer for total CFI, total CFF is 22 negative. Done with this one. All right, we are done with CFO. Here we are done with the CFI and we are done with CFF. Now we want to do a finishing touch. Finishing, that means we want to close this cash flow statement. Okay, what do we have in this one? Okay, total cash flow. So that means CFO plus CFI plus CFF. Okay, so this one, add this one, add this one. But somehow this one is negative, so you need to make it as minus. 44100 plus 10560 minus 22860, you will get 31,800. Okay, and then you just go for next part, cash beginning of the year and cash end of the year. Okay, beginning of the year and end of the year, you just copy and paste there. Okay, beginning that means 36,000 and 25,000. Okay, all right. So, okay, hold on, hold on. Let me check. It's supposed to be 10,800. Okay, let me cross check the answer. Okay, give me 2 or 3 minutes. Let me check. Okay. Oh, okay. I made a mistake somewhere here. This one. 12,000 minus 36,000. Okay, I made a mistake. Sorry about that calculation. The calculator. This part. 12,000 minus 3600. 18,600. Okay, so 18,600. The effect should be decrease. My bad. Okay. So insert symbol. So 18,600 ada current liabilities. 18,600. Okay, 18,600. Okay, let's check the answer. Wait, 2840 plus 3840 plus 6,000 plus 2400 plus 4800 minus 18,600 minus 9360 minus 6960 minus 18,000 minus 18,165. 1,500. Ah, yes, correct. 10,800. Okay. Okay, done. Okay, so I check the mistake already. Oh, okay. Yap and Yanisha. Okay, you see here, this is the final answer. This is the final answer, 10,800. How do I get this one? 1,005 plus 10,560 plus negative 22,860. You get this one, 10,800, which is similar to the difference between this one. You see? Yeah, the difference between 2012 and 2011. So therefore, yeah, as you can see here, that is a correct way on how to do this one, cash flow statement. Okay, to make it more neat and tidy a little bit. So we just put here as this one, this one, this one. Okay, bottom. Okay, so done. So this is the part, 10,800 plus 36,000, and then cash at the end of the year 25,200. So that is look at the question back. This one 25,200. Yeah. Okay. All right. This is how you do. You can snap the picture. Yeah, you can snap the picture. Okay. Yap and Yanisha, any question? Yeah, Yap and Yanisha. Okay. Okay, Yanisha, yeah, equity, I know, yes, Yanisha, I will upload the YouTube. Okay, sir, I cannot understand why is it increase or decrease. Okay, let me illustrate to you once again. Maybe I'm using this extra, sorry, Google bot. Google bot is the one. Okay, what bot, Okay, let's have a look here. Let me illustrate to you on why increasing and decreasing as part as this one. Okay. Okay, let me draw to you. Okay, let's have a look at, okay, we have three part here, which is asset, liability, and equity. Okay, let's have a look here at the first part, which is asset. Okay, let's say this is your company. Okay, ABC, yeah, ABC company. All right. Why is it increase and decrease? Okay, there are two situation. There are two situation whereby, okay, the first one is selling asset. Okay, I think use this one. Okay, so there is a first situation here whereby, not this one, textbook. Okay, this one, let's say you're selling asset, right? Okay, so can you imagine, yeah, if you're selling asset, that means, for example, yeah, if you are selling furniture, if the company ABC selling furnitures, and then the company is selling land, yeah, building and so on, what will happen is, yeah, they are selling to another people, okay, and then from the selling money, the money that they will get will be injected into ABC company. Okay, I give you a numerical example. Okay, let's say before this you have 10,000 asset. Okay, and then yeah, next year you selling off 5,000. So the question here is, where does another balance 5,000 goes? Okay, 5,000. Okay, this is the what we call as the asset balance, which is 5,000. After you selling an asset, it will become 5,000, and then this 5,000 will be goes into cash. Is converted into cash. So that's why, okay, in ABC company, yeah, they will injected a cash of 5,000. Okay, that is the first situation. Okay, the second one is when companies purchase asset. Okay, purchase asset happens whereby company buys more asset. Okay, if the company is buy more asset, that means your company need to expend their money. Yeah. So let's say I give numerical example. Let's say before this, currently they have 15,000 ringgit value of asset, and then they purchase more furniture or purchase vehicles. They say they purchase a vehicle of not vehicle, furniture of let's say 2,000. Okay, so in accounting equation, if you learn accounting, yeah, the asset will become 17,000. Okay, what happened to the 2,000? The 2,000 will be money out. Yeah, money out from the company, and then 2,000 will be paid to the furniture supplier. So that's why here that means negative 2,000. So if purchase asset will lead to decrease cash. Yeah. Okay, in Malay kurang lah duit you sebab you beli because you pay because of you want to purchase asset. If you're selling asset, your asset will be decrease, but your cash will be increase. Yeah, because you are selling asset to someone and then your cash will be increased. But if you purchase asset, which is your add more asset, the cash will be decreased. So that is the first part. Okay, next part, which is liability. Okay, as far as liability is concerned, okay, let's say come again, ABC company. Okay, there are two situation, There are two situation. Okay, let's say add loan. Okay, the second situation is payback loan. Okay, logically, if you apply or add loan, let's say for example, you currently you have 20,000 loan. Okay, it is. I think. Okay. Okay, currently you have 20,000 loan. And then you want to add some more. And next year you want to apply loan more by 10,000. So what will happen is, your loan will become 30,000. Okay, and then your 10,000 here will be injected into this one. That means, add more. Because you loan more, that means you get money more. That is the first one, That means add another 10,000. Okay, let's say what happens if payback loan. Okay, payback loan means that previously you have 20,000 and then you want to reduce loan by payback loan into bank. So let's say you pay by 5,000. Therefore, your loan will be reduced to 15,000. So that means, if you pay by 5,000, that means 20 before this 20,000, and then now your loan is reduced to 5,000. Your 5,000 here will be do as a cash out. Yeah. So that means this one, if you pay more or pay more to reduce loan, that means it will reduce cash. But if you borrow more or add more, it will increase your cash. Okay, from 20,000 to 30,000. And this one from 20,000 to 15,000. Same goes to equity. Yeah. Add money, yeah, add cash because of more people coming and investing. But yeah, your cash will be reduced because of, yeah, you need to return back your the company's money to the investor because they're selling back the shares. Yeah. So I hope that this is explain this one on how to. So this one, yeah, Nisha, yeah, you may refer more on this one. Yeah, because you're asking why increase, why decrease. So I put here this reason as well. Yeah, to purchase more asset, to sell off more asset, and then cash inflow and cash outflow is already in the guidelines here. Okay. Can you email me the recording class? Okay, no need because after this, usually I will upload at the YouTube and then you can refer to the YouTube that I share with you later on. Okay, any other question? Yanisha and Yap, any other question? Okay, if you don't have any question, it's okay. All right. Later on, you may try question number 3 or question number 2 or question number 1. I suggest you better to try, but because if you don't have if you have any issues along the way, you are not clear on how you along the way, you have some of the issues. Please let me know so I can solve it for you. Yeah. Question 1, question 2, and question 3. I'm encourage you to do this because in the midterm also come out this kind of question. Yeah.